Every human being has heard this cliche. You don't make money by saving, you make money by investing. But data shows that more than 75% of people who actively invest in the stock market actually lose more money than they make from it. That means you're 3 times more likely to lose your capital in the stock market than you are to gain more money. Wow. See, one of the first things I learned about investing is this: buy low, sell high. And in theory, it makes sense, right? You buy low, you sell high. That difference is the profit that you make. And it should be pretty easy to do, right? Wrong. In reality, people hardly ever abide by these rules. In fact, both Warren Buffett and Forbes both reported in 2024 that 2 of the most common reactions from market participants are the direct opposite of these expectations. One of them is called FOMO, which sees market participants invest in stocks after, not before, their prices begin to rise. And the other one is panic selling, which sees market participants dumping rather than buying stocks when their prices begin to go low. And guess what? We're not alone. In fact, history is replete with stories of people who make this same mistake over and over and over again. I guess in that sense, we haven't really evolved much. Sorry, Darwin. Yet, there are people like Warren Buffett who have consistently beaten the market for decades in a row. How? Research shows it comes down to people's psychology about money. So how does one become an investing god? In this video, we'll be looking at some of the wildest investing moments in history and what we can learn from them. We'll also talk about some of the stock market related investments that exist and discuss some strategies for staying ahead of the market. This will be a good primer for the next episode, where I'll be showing you live how I invest in the stock market using one of the more popular trading platforms. I will also show you at some undisclosed part in that video how to make your first $100 to start investing in the stock market. So if you don't want to miss that video, this is a good time to subscribe to my YouTube channel and turn on notifications so that you don't miss that video when it comes out. So let's talk. So what are some of the most insane moments in stock market history? First, let's talk about Tulip Mania. See, if you've ever blamed yourself for losing money in Ponzi schemes like MMM or in cryptocurrency or other types of investments, this is your sign to cut yourself some slack. Your ancestors made way worse financial decisions. Almost throughout the 1630s, Dutch traders were involved in the rather unconventional trade of tulips as some sort of investment. Yes, the flower. Okay, let me explain. So around the 1500s, tulips had been introduced to Netherlands as a luxury fashion item for women. And the middle class people realized that they could buy and hoard these tulips in hopes of flipping them for a profit. And this trade actually went on for more than 7 years, until in 1637, somebody woke up and was like, wait, this does not make any sense. And then the entire market, valued at more than $1 billion in today's currency, came crashing down, with a number of middle-class Dutch people having to declare bankruptcy. And of course, there's the Great Depression that lasted an entire decade between 1929 and 1939. It is remembered as the worst economic collapse in world history and literally sent 1 in 4 people into poverty. It wiped out several hundred millions of dollars from US capital markets and was caused by market speculation and short selling. And of course, there's the 2002 dot-com bubble burst, the 2008 financial crisis, and the market crash that happened during the 2020 COVID-19 pandemic. Fun fact, American President Franklin Roosevelt introduced Social Security as a way to jumpstart the US economy after this market collapse. In all of these market crashes, there's a number of key lessons that we can learn to be better investors. 1. Markets are actually quite efficient, and even if it takes a while, the market will eventually correct itself. 2. Hype is different from value, and fundamentals are key. And so if you're investing in any stock, you need to have a good reason why you think the value of that stock will increase in the long term. 3. If you are going to be investing in the stock market, you need to fall in love with reading the news. That is the one thing that the market responds to immediately. And 4, market cycles always repeat. If you make the mistake of buying a stock when the price is already high, you don't need to panic sell when the price begins to crash. So long as you bought a good stock that has a solid fundamental, hold on to it. There are always periods of peaks and troughs in every market, and if the price tanks today, it will eventually rebound. Now, let's talk about the different types of stock market investments that exist. The first one is bonds. And bonds are essentially promises to make repayments by one entity A, which is usually a government or a corporation, to another entity B, which is usually an investor or a group of investors, of an amount C, which is the borrowed amount, plus an additional interest D. Ideally, the additional interest portion will reflect the intrinsic risk of the loan or the bond, which means the more likely it is that the borrower will not make a repayment or will default on the loan, the higher the interest that is requested. It is called a bond because it essentially binds the borrower A to the lender B until they've made full repayment of principal amount C and interest portion D. The second type of stock market investment are shares, or more specifically, common shares, which represent ownership interest in companies or corporations. Ideally, if you own X percentage of the total number of shares of a company, it means that you own X percent of that company. For example, if a company worth $100 were to issue 100 shares, it effectively really means that each share is worth $1. And if you were to own 10 of those shares, you now own 10% of the company. Common shares are different from other types of shares like preference shares and treasury shares, but that's all you need to know. If you want to know about treasury shares and all of that, go take the CFA. But essentially, shares are ownership interests and their value fluctuates depending on the market's belief in the value of the company or its future prospects. Question: why do you think governments cannot issue shares even though they can issue bonds? The reason is because shares represent ownership interest, like I said earlier, and if governments were to issue shares, imagine that one person were to buy 50% of the shares of a government. It will mean that person owned 50% of the government or the country or the state. And the governments are supposed to not be owned, the countries are supposed to be equally owned by all citizens, and so governments cannot issue shares. The third type of stock market investments are called mutual funds, which essentially pool funds from a large number of investors to then invest in a pool of companies. Let me ask you a question. How many publicly traded companies are there in the US? There's more than 5,000, which means a single investor would need at least $5,000 to invest $1 in each of these companies. What mutual funds do is they collect money from a large number of investors so that they then buy shares in each of these 5,000 publicly traded companies. And by owning a part of that mutual fund, each individual investor indirectly owns a tiny bit of all of those 5,000 companies. There are different types of mutual funds, but the one I want to talk about today is the index fund, which does not actively try to beat any metric, but instead passively tracks an index or a group of companies. The most common one being the S&P 500, which passively tracks the 500 largest United States companies. The final type of stock exchange investment that I want to talk about are the ETFs, or the exchange traded funds, which are very similar to mutual funds in that they are also passively managed and they also track indexes like the S&P 500. The main difference is that while mutual funds can be traded on platforms like Robinhood, Vanguard, Fidelity, and the likes, ETFs can only be traded on national exchanges like the New York, London, Hong Kong, and Nigerian stock exchanges. Finally, how do you avoid FOMO and panic selling and make the most of stock market investments? 1. Invest for the long term. This has two key advantages. 1, it insulates you from short-term market movements, and 2, it enables you to maximize tax gains. 2, invest very passively. Data shows that in the long term, passive investment always generates more than active investment for most people. 3, choose low-fee managers. Mutual fund and ETF managers usually charge a very small amount for helping you manage your portfolio. And even though these percentages look very tiny, in the long term, say 10 or 20 years, when compounded, these fees can significantly impact on how much return you make from the stock market. 4, choose a diversified portfolio. Do not, I repeat, never invest in one asset or one stock, no matter how much faith you have in that stock. Try to diversify your portfolio as much as possible so that if one stock is not doing well, the other stocks that are doing well in your portfolio can counterbalance the impact of that stock. 5, and perhaps the most important of them all, never invest in stocks that are directly correlated with your source of income. So if you work at Google, for example, you should not own Google stock as part of your portfolio unless they were given to you by your employer, and you should try to sell them immediately they become sellable. The reason is because holding them leaves you doubly exposed to Google's unsystematic risk, which is the risk that is specific or particular to Google. So let's imagine that you work at Google, for example, and 60% of your portfolio is Google stock because you love Google so much. If something were to go wrong with Google and they lay you off, first, you would lose your income, and second, because something is wrong with Google, Google's stock is also going to tank, which will reduce the value of your portfolio, which means you've lost in two ways. You've lost your income and you've lost your investment. That's double exposure to Google's unsystematic risk. What you want to do is to invest in a company that has nothing to do, which means it is not correlated with your source of income. So if you work at Google, for example, you should own stock in companies like utilities client and things like that, so that if something were to be wrong with the technological industry that makes Google lay you off, at least the energy or oil and gas industry might be doing great and your investment will be okay. Finally, limit your exposure to market bubbles. A market bubble is a sort of market event that is super hyped, super popular, but is a very small subset of the entire market. A good example is the AI bubble. Everyone seems to be talking about AI this, AI that, and you can be tricked into putting all of your money into AI-related businesses. That would be a mistake. Another bubble is the EV bubble. Everyone is talking about Lucid and Tesla and all of the other EVs, BYD and the likes of them. Do not put all of your money in EV companies. You should have a very diversified portfolio. Well, I hope you've learned one or two things about investing in this episode. In the next episode, I will walk you through how I invest in the stock market live and also teach you how to make your first $100 to invest in the stock market. So look forward to that video, and I'll see you in the next episode.